Look, I need you to be honest with yourself for a second. You just got a notification that your paycheck hit your account. You open your banking app, you see that number, and you think to yourself, okay, I can definitely afford to order takeout tonight. Maybe I'll grab that new gadget I've been eyeing. I'm doing pretty well. But then 2 weeks later, you're checking your account balance before buying groceries, doing mental math at the checkout line, wondering where all that money went. Sound familiar? Here's the thing, you're not actually bad with money. You're just experiencing one of the most dangerous psychological phenomena in personal finance, and it's costing you thousands of dollars every single year without you even realizing it. My name is Elon Musk, and I spend way too much time thinking about why smart people make terrible financial decisions. If you're someone who feels like you should have more saved by now, who can't figure out why your bank account never seems to match what you think you should have, or who's ever said, I make decent money, where does it all go? Make sure to hit that subscribe button and give this video a thumbs up if this helps you out. So here's what's happening. There's this gap, this massive, wealth-destroying gap between how rich you feel and how rich you actually are. And I'm not just talking about a few $100 here and there. According to research from the Federal Reserve Survey of Consumer Finances, the average American household overestimates their available discretionary income by roughly 30 to 40%. Let me put that in real numbers. If you think you have $1,000 of spending money this month, you probably only have about $600 to $700. You're making decisions based on money that doesn't actually exist. Now you might be thinking, wait, I know how much money I make. I know how much is in my account. How can I be wrong about this? And that's exactly the trap, because knowing your salary and knowing your actual spendable wealth are two completely different things. Let me show you how this plays out in real life. Let's say you make $60,000 a year. That's roughly $5,000 a month before taxes. Now, here's where it gets really interesting. When you think about your wealth, your brain naturally gravitates toward that $5,000 number, right? That feels like what you make. That feels like your financial reality. But here's what most people don't realize. After federal taxes, state taxes, Social Security, Medicare, you're taking home maybe $3,800 to $4,000. Already, you've lost $1,000 to $1,200 that your brain was counting as your money. But we're just getting started. Your rent or mortgage, let's say that's $1,400. Health insurance premium that comes out of your check, another $200. Your car payment, $350. Car insurance, $150. Student loan payment, $280. Your 401k contribution that you're actually being responsible about, $250. You see where I'm going with this? You started the month thinking about $5,000, but before you've made a single discretionary decision, before you've bought a single coffee or ordered a single meal, you're down to about $1,370. That's it, that's your actual discretionary income, not $5,000, not even $4,000, but $1,370. And this is where people absolutely destroy their finances, because psychologically, you're still anchored to that bigger number. You're making spending decisions based on feeling like you have $5,000, when in reality you have about a quarter of that to work with. Here's the thing that really gets me frustrated. The financial industry has actually designed systems that make this worse. Think about it. When was the last time you saw your gross income versus your actual take-home pay side by side? Your employer tells you that you make $60,000 a year. Every job posting shows gross salary. When you got that raise last year, they told you about the increase in your gross pay. But nobody sits you down and says, hey, your actual spendable income after all mandatory expenses is $16,440 a year. Because that number feels depressing. That number doesn't make you feel successful. But that's your reality. And until you internalize that reality, you're going to keep overspending. Now there's another layer to this that makes it even worse. I call it the wealth illusion, and it's happening in 3 specific ways that are absolutely killing people's ability to build actual wealth. Illusion number 1, the asset trap. Look, you bought a house for $300,000. Great, you've got $50,000 in equity. On paper, you're worth $50,000 more than you were before you bought the house, right? So psychologically, you feel $50,000 richer. But here's what your brain conveniently forgets. That equity is locked in your house. You can't spend it. You can't invest it. And if you try to access it through a home equity loan, guess what? Now you've got another monthly payment that reduces your actual discretionary income even further. But people walk around feeling wealthy because they own assets while their checking account is perpetually empty. I see this all the time with people who have nice cars, nice houses, and no actual liquidity. They're house poor or car poor, but they feel rich because they own things that look expensive. According to a mutual study, 78% of Americans say they feel financial anxiety, but here's the kicker. 45% of people with a net worth over $1 million still feel that anxiety. Why? because net worth and actual spendable wealth are not the same thing. Illusion number 2, the credit line confusion. This one is absolutely devastating, and most people don't even realize they're doing it. You've got a credit card with a $10,000 limit. Maybe you've got 3 cards with $5,000, $8,000, and $12,000 limits. That's $25,000 in available credit. And here's what happens psychologically. Your brain starts treating available credit like available wealth. You're not thinking, I'm going into debt. You're thinking, I have access to this money. The payment feels manageable. Maybe it's just $200 a month, so you swipe the card. But here's the math that destroys people. Let's say you rack up $15,000 in credit card debt at 22% APR, which is actually pretty typical right now. If you're paying $200 a month, do you know how long it takes you to pay that off? Try 134 months, that's over 11 years, and you'll pay over $11,700 in interest alone. You will have paid nearly $27,000 to buy $15,000 worth of stuff. But when you were swiping that card, you felt rich enough to afford it. That's the illusion. Illusion number 3, the lifestyle inflation trap. Here's where it gets really interesting, because this is the one that catches people even when they're trying to do the right thing. You get a raise, let's say it's a solid raise, you go from $60,000 to $70,000. That's an extra $10,000 a year. You feel like you've just gotten significantly wealthier, right? You earned it. You deserve to enjoy it a little. So maybe you upgrade your apartment, just $200 more a month, you can afford that now. Maybe you finance a newer car because, hey, you're making more money and you should have reliable transportation. That's $150 more a month than your old payment. Maybe you start eating out more often because you don't have to be as careful anymore. That's probably another $150 a month. Boom, you just spent your entire raise. Actually, scratch that, after taxes, your raise was really only about $7,000. You just committed to $6,000 in additional annual expenses. You've increased your lifestyle, but not your actual wealth. And here's what most people don't realize. That raise was supposed to be your opportunity to finally get ahead. That was your chance to max out your retirement account, to build a real emergency fund, to start investing. But instead, you feel exactly the same financially as you did before the raise. Maybe even a little, because now you've got less breathing room. Look, I'm not trying to make you feel bad here. I'm trying to wake you up. Because the brutal truth is that feeling rich is not the same as being rich. And every single day that you make financial decisions based on how you feel instead of what's actually real, you're pushing actual wealth further and further away. The Financial Industry Regulatory Authority did a study on financial literacy, and they found that 63% of Americans can't pass a basic financial literacy quiz covering interest rates, inflation, and risk diversification. But here's what gets me: these aren't dumb people. These are smart people who just never been taught to see the difference between perceived wealth and actual wealth. Let me give you a concrete example of what this costs you over a lifetime. Let's take 2 people, we'll call them Alex and Jordan. Both make $60,000 a year. Both get the same 3% annual raises. Both work for 30 years before retirement. Alex feels rich. Alex spends money based on gross income, treats credit limits like available funds, and lets lifestyle inflate with every raise. Over 30 years, Alex accumulates some retirement savings, maybe $150,000 in a 401k, but also has revolving credit card debt, made minimum student loan payments that took 25 years to pay off, and never built any real wealth outside of retirement accounts. Jordan, on the other hand, has a completely different psychological relationship with money. Jordan calculates actual discretionary income every single month. Jordan treats any money that isn't physically in a checking account as money that doesn't exist. Jordan keeps lifestyle inflation to just 1% per year, even when raises are 3%. Over those same 30 years, the difference is staggering. Jordan retires with $890,000 in retirement accounts, a paid-off house, no debt, and another $200,000 in taxable investment accounts. That's over $1 million more in actual wealth. Same income, same time period. The only difference: Jordan stopped feeling rich and started being rich. Now you might be thinking, okay, this is depressing. You're telling me I'm actually poor and I just didn't realize it. No, that's not what I'm saying at all. What I'm saying is that you need to rewire how you think about your money, because the way you think about it right now is designed to make you feel good, not to make you wealthy. Here's the shift: stop measuring your wealth by your income or your assets. Start measuring it by one number and one number only: your monthly free cash flow after all mandatory expenses. That's it. That's the number that determines whether you're actually building wealth or just running in place. If that number is negative or close to zero, you're in trouble, regardless of what you make or what you own. If that number is positive and growing, you're building actual wealth. So here's what you need to do, like starting today. Step 1, calculate your real discretionary income. I need you to sit down right now, pause this video if you have to, and do this math. Take your actual monthly take-home pay, not your salary divided by 12, your actual take-home pay after every deduction. Then subtract every fixed expense you have, every single one: rent, mortgage, car payment, insurance, minimum debt payments, subscriptions, everything that you have to pay no matter what. Whatever's left, that's your real discretionary income. That's the only money you actually have to make choices with. Write that number down. Put it on a sticky note on your bathroom mirror if you have to. That number is your financial reality. Step 2, create a zero-based budget for that discretionary income. Every dollar of that discretionary income needs a job before the month starts. Groceries, gas, savings, investments, entertainment, allocate every dollar. And here's the key: allocate savings and investments first. Pay yourself first, then budget what's left for everything else. If you can't make the math work, if there's more month than money, you've got exactly 2 options: increase income or decrease expenses. There is no third option. Credit is not an option. Helping things work out is not an option. Step 3, automate your wealth building. This is critical. Whatever you decided to save and invest in step 2, automate it. Have it pulled from your checking account the day after you get paid, before you can think about it, before you can talk yourself out of it. Because here's what most people don't realize: building wealth is not about finding extra money at the end of the month. There will never be extra money at the end of the month. Building wealth is about forcing yourself to live on less than you make by removing the money from your account before you can spend it. Step 4, implement the 48-hour rule. For any discretionary purchase over $100, you have to wait 48 hours before buying it. No exceptions. Put it in your cart, walk away, come back in 2 days. If you still want it, if it still makes sense, if it fits in your budget, fine, buy it. But here's what happens in those 48 hours. The emotional high of wanting to buy something wears off. You start thinking about what else you could do with that money. You realize maybe you don't need it as much as you thought. According to consumer behavior research, about 60% of impulse purchases don't happen when you implement a waiting period. Look, here's the thing that I really want you to understand. This isn't just about having more money in your account. This is about freedom. When you feel richer than you are, you're trapped. You're trapped by debt payments. You're trapped by a lifestyle you can't actually afford. You're trapped in a job you might hate because you need every single paycheck just to maintain the illusion. But when you understand your actual wealth, when you live below your means intentionally, when you build real assets and real savings, that's when you get options. That's when you can take a risk on a career change. That's when you can start a business. That's when you can retire early or work part-time or say no to things that don't serve you. Actual wealth isn't about feeling rich, it's about having choices. So here's my challenge to you. For the next 30 days, I want you to do something radical. I want you to calculate your actual discretionary income using the method I showed you. Write it down. And for the next month, pretend that's the only money you have. Act like every other dollar doesn't exist. It's going to feel tight, it's going to feel restrictive. You're probably going to feel less rich than you did before. Good. That discomfort is the gap between your perception and reality. That discomfort is what's been costing you wealth your entire adult life. Sit with that discomfort for 30 days. Actually live within your real means for 1 month. And I promise you, at the end of that month, you're going to see money left over that you've never seen before. You're going to have money in your account at the end of the month instead of wondering where it all went. That's when it clicks. That's when you realize that feeling rich was making you poor, and that the path to actual wealth requires feeling a little bit uncomfortable in the short term. If this video helped you see your finances differently, do me a favor, hit that like button and subscribe. Share this with someone who needs to hear it, and drop a comment below telling me what your real discretionary income turned out to be. I read every single comment, and I want to know if this exercise opened your eyes the way I think it will. Until next time, stop feeling rich and start being rich.